Good afternoon, everyone. Welcome to an Option Hotline free trading webinar. My name is Natalie. I'm going to be your moderator this afternoon. You can see the webinar disclosure slide right here. Just take a quick read through that and make a note of these links. You can read through them at your convenience. And we are going to get started. We are hosting Keith Harwood this afternoon. He is the Chief Options Strategist of Option Hotline, and he is going to be presenting to you all today, talking about how options are cheap and stocks are explosive. So we're really excited about this presentation. It's going to be a plethora of information for you all, and we are happy to have him. Keith, are you with us?
I hope so.
Yes, you are. I hear you.
Perfect. That's a good start, right?
Wonderful. Welcome. Thanks for being here this afternoon. And I want to welcome everyone who has joined for live attendance this afternoon. I know we all have busy lives, so we are thankful for you all for showing up, and I think you will be happy with the information you received from Keith. Keith, if you want to go ahead and start pulling up your presentation and share your screen when you're ready. I'm just going to let everyone know again, if you have questions during Keith's presentation, please type them in the chat box, and I'd be happy to get those over to Keith at the end of his presentation to answer them. Time permitting. All right, Keith, I can see your presentation. It looks lovely. So feel free to start when you're ready.
All right. Well, thank you again to everybody that joined. We're really looking at a weird market environment, and I wanted to talk today about how options are kind of cheap relative to the way that the stock market is explosive. So it's a very unique opportunity, I think, that we've got here, and I want to make sure that we talk through how I'm approaching the market and just let you guys know what I'm thinking about right now. So before we get into the actual content, I always have to do this. The disclosures: all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. So if you guys can just all take a quick gander at this content here on this page, on this slide, I appreciate it, and then we will get into the real stuff. All right. If you have questions, I think Natalie already mentioned it, but if you have questions coming up during the presentation, definitely throw them into the Q&A or the chat box. I will do my best to answer them real time. If there are questions that are just better answered at the end, I will do so at the end. If they are just real good real-time questions, I'll answer them in the middle of my presentation. But anyway, for those of you that don't know me, I am Keith Harwood. I used to trade in the CBOE floor, so I was on the floor through the whole subprime crisis. Kind of a crazy time. As markets changed, I moved off floor, started looking for ways to trade that were a little bit more, we'll call it, advantageous for the trader. When I was on the floor of the CBOE, market trading was all about just taking advantage of the bid-ask spread, and that opportunity was kind of short-lived, frankly. So as I looked for ways to transition my career, I recognized the fact that you needed to have an edge in, sort of an edge better than just being bid-ask spread. Okay, so skew, market movement, technical directions, all those other things became a really big, important part for me. I went to a hedge fund to learn more about the technical trading. I got my MBA from University of Chicago so that I could learn more about just statistics and all that other good stuff. At the end of the day, for me, the advantage to the marketplace is big. I think that we've got a lot of advantages as long as we understand where those advantages lie. And that's why I joined Option Hotline. That's why I came to this sort of educational side of things to try to figure out how to help others understand the advantage that we all have. Because at the end of the day, the market maker right now is just a computer. It's a series of really, really quick moving computers looking for ways to expand upon their ability to trade the bid-ask spread. And that gives us an edge. So the fact that they are just inventory management machines gives us an edge over the marketplace. And so what we want to do right now is try to figure out how to really get those edges into our pocket instead of into their pocket. So if you have to leave early, you should feel free to contact me, Keith at optionhotline.com or 312-600-8004. Feel free to call me. I really do like talking to people about the options market. So I would love to have you call me so we can talk more about the markets if there are any questions. Okay. So what are we going to talk about today? First off, I always kind of lead in with why I use options instead of why I just do a stock trade, and why volatility matters. These go hand in hand. Why I use options, why I use volatility trading is all about finding the ways to leverage a trade and define my risk. Now, in addition to that, I want to talk more than anything about the technical trading setups that I'm looking at in both sectors and stocks right now, and in particular, the sectors that are fitting more of a trend trading signal and the sectors that are fitting more of a swing trading signal. These are very different types of options trades. And this is why option trading really matters to me, is to understand where I can find my leverage for either a technical trade or more of a swing trading trade. And then, of course, how I use options for these setups. All right, options do have risks. Options are not risk-free, of course, as I think most of you understand. But at the end of the day, I think it's really good to reiterate that options have an additional transaction cost. They often have higher commissions and fees than stock trades. Options have assignment risk, which is not necessarily applicable to what we're talking about today, because I'm talking about buying options. But if you sell an option, you have that assignment risk where a short option position can be assigned, i.e., if you sell a put, you can all of a sudden find out that you're long stock. If you sell a call, you can all of a sudden find out that you're short stock. There's a lot of risk associated with that. But buying stock means that you are going to have decay risk. So buying options tend to decay over time, very much like an insurance contract. Okay. So if you buy insurance, you know that every day it's going to sort of decay. When you buy options, every day it's going to decay. Volatility is a big risk with options. If implied volatility goes up, then the option price goes up. If implied volatility goes down, then the option price goes down. This is just a basic element of options. When we have an expected increase in movement, an expected increase in volatility, that can create an increase in the price point. So we're not, hopefully, when we buy options, we see implied volatility go up. But when we sell options, we expect and hope that implied volatility will go down along with lack of movement. All right. So given all this, what is the reason that we use options? Well, first off, here is my sort of standard pitch on what stocks do versus what options do. Okay. So when you have a stock, you buy those shares, say 100 shares of stock for $100, you're going to put 10 grand in the market. So you have $10,000 in the market and you have a defined risk to yourself, but not necessarily defined risk to the market. Because if you think that you're going to get out of the stock if it goes below $90, but it gaps down, you cannot get out at $90. So you have this defined risk, except for the fact that this defined risk doesn't actually apply if the stock has really bad earnings, has really bad, sort of fundamental news or something else like that comes up. You could see the stock gap from $100 down to 50. That would be really, really bad. If you buy 100 shares, you thought you only had $1,000 of risk, but it turned out you had $5,000 of risk or more. On the upside, you know your upside because you know where you're getting out if the stock goes well. You have a target price of, say, $120 a share. You got 20% of upside. This is how you make $2,000. However, the alternative would be to buy a call, because the call option would give you more upside with defined risk to the downside. So if you had an option that expired in 1 month, buying the stock for $100 a share, it gave you the right but not the obligation to buy the stock, and the upside can be greater. Because if you buy one call for $5, you now are risking $500, because each call at $5 gives you the right to buy 100 shares with limited downside. If the stock drops to $50 in our kind of scenario that we've talked about, you don't lose the money. Now, if you buy 2 calls, you can spend that same $1,000 that we were talking about before. We were talking about $1,000 of risk down to the $90 range. And that would give you an extreme upside potential with a very well-defined downside risk. If you compare the stock to the option, really what you're saying is that if this stock goes below $90, I have the same amount of risk, but I don't have to worry about it in case there is something really, really bad that happens. And if the stock goes above $110 a share, I make a lot more money than I would have if I was just buying the stock. And that's the whole point of options, is to try to find that upside potential and define that risk to the downside. So I'm all about defining my risk to the downside. I'm all about looking for leverage to the upside, and I'm trying to figure out ways to do that every day. Because at the end of the day, if I can find leveraged setups to give me really good upside, and or I'm a little nervous about the market, which I am today, then why wouldn't I buy options instead of buying stock? This gives me my defined risk. It gives me my leverage. So that's what I want. Now, when I look at implied volatility for a stock or for an option, the whole key is finding where leverage is actually cheap. So it's not about just buying leverage every day that I'm looking into the markets. I'm looking for when implied volatility is cheap. And given the current market scenario, implied volatility is cheap, which means options are cheap, which means both defined risk is cheap and leverage is cheap. Now, when I find the scenario like we've got right now, when implied volatility gets cheap, like we're talking about right now, it gives me a really good discount. So if I expect that an individual stock should be about 36% implied volatility, and I can buy 30% implied volatility in the options market, I've got a good discount. What I'm doing is I'm buying something on sale. Okay. So when implied volatility is cheap like it is right now, when I buy an in the money option, it's like 8% on sale. When I buy an out of the money option, it's closer to 30% on sale. So for me, I want to buy options that are short-term, super good sales, or longer term, getting my 8% discount. Okay. So the market right now is giving me a discount on where option volatility should be. So if I can get my options at a discount, that's a good thing. If I can buy anything at a discount, that's a good thing. If I find something that I want to buy and it happens to be on sale, that's a good thing. And that's what we're getting right now in the options market. So just to give you kind of a little perspective here, when implied volatility is high, you can see that options kind of perform a lot like stock. No matter what call you buy, it kind of behaves a lot like stock. You just don't have that big leverage scenario. When you go into a low implied volatility, high leverage position, all of a sudden there's leverage here. And in particular, it comes from the out of the money options. And that's what we're looking for in the options market, that the $106 calls in this $100 stock could potentially create multiples or generate multiples on my return because of the fact that implied volatility is just simply too low relative to the expected potential payout. Okay. So when the market right now wants to give me that setup, I want to buy out of the money options or at the money options, not in the money options. Now, when I look at the VIX is at its lows for the last 6 months. It's a little higher than that, but it's not far off. Okay. So when the VIX is low, and this is even given the fact that we've got earnings coming up right now, the VIX is very, very low. We've got very low implied volatility for the market. We've got leverage and we've got it for cheap. So given that, I kind of like buying options right now. So why wouldn't I try to leverage a move like this green line here if I can find the right technical setup? And if I'm really just more of a trend follower, I can buy these in the money options, the $94 calls in the $100 stock, and get the same defined risk, get that benefit of defined risk for a trend following system. So I can either swing trade with the green line or trend trade with the blue line, but either way, I don't want to walk away from this market and say that I should be buying stock. To me, right now, it looks like buying options is the right way to go. Now, I kind of led into this whole thing with how do I get into my systems? So the first thing I do is if I'm doing a trend following system, I look for simple moving averages. So simple moving averages take the average closing price over a recent period. They're a very simple trading signal. Common examples are the 10, 20, 50, 100, and 200-day simple moving average. People use them all the time. The idea is that if you take, for example, the 10-day simple moving average, you would take the closing price for the last 10 trading days. And if we are above the closing or the average closing price for the last 10 trading days, that's bullish. So I would take 2 weeks of closing prices and say, hey, you know what? If we're above those, this is good. That gives the bull a little bit more oomph. That makes that bullish trader a little more confident. When you've got like 20, 50, 100, and 200-day moving averages, like even go all the way out to the 200-day moving average, You're taking the average closing price for the last 200 trading days, which is pretty close to a year. So if we've closed above that price over the course of the last, trading day, we know that basically the guy that's been buying for the last year is making money if he's buying every day, a little bit every day. That's a good thing for the bull. So the 10-day moving average is kind of my shortest term that I look at. It's the idea that the guy that's been buying over the last 10 days is making money. When I look at the 200-day moving average, I think that the guy that's been buying for the last year has been making money. This creates momentum for the market. It creates a confidence for the market. A guy that's been buying for the last 10 days and is making money is confident that he can buy tomorrow and still make money. The guy that bought over the course of the last year and is still making money is generally confident. And that makes sense. I mean, that's the whole point of a trend, right? When you've got a market that is trending upwards, you're going to keep the price above the 10, the 20, the 50, the 100, and the 200-day simple moving average. And that's what we've got right now, particularly in the NASDAQ. Okay. So let's look at the S&P 100, or sorry, S&P 500. The purple line on the screen here is the 10-day moving average. The green line is the 20-day moving average. The blue line is the 50-day. The yellow line is the 100-day. The red line is the 200-day. The market hasn't fallen below really any of them. So the S&P 500 is trending higher and giving everybody that uses simple moving averages, sort of this essence of knowing that they can buy and they're never going to lose. Okay. If we get below the 10-day moving average in purple, maybe we finally find some people that are willing to sell. But until then, why would you sell? The market is bullish. The market is explosive. It's incredible. If we go to the NASDAQ, it's even firmer. Okay. So you could see that when we were dealing with the S&P 500, that we kept trying to test the 10-day moving average here a couple of days ago. The NASDAQ doesn't even test that. The NASDAQ just wants to keep going. So we have a trend here in the NASDAQ. We have a trend here in the market that is completely bullish. And we need to look for ways to leverage that bullish trend with defined risk because of the way the VIX is currently priced out. If I go to semiconductors, which are a great leading indicator for the NASDAQ, really since about the middle of October, they've launched off and created this bullish trend too. They're at highs. They're going to new highs. Why would we ever consider selling semiconductors given the current trend? There is zero risk outside of the 10-day moving average, right? So once we get below the 10-day moving average, we have to start walking away. We have to start pulling back. But the way that I look at the S&P 500, the NASDAQ, and semiconductors right now, we're really explosive. And we've got some great upside to this market. We can trade this trend. We know our defined risk. Our defined risk is that 10-day moving average. The purple line is our defined risk. All right. Given all of this, I want to make sure that you guys have a sense of how I look for my trading setups. The Outlier Watchlist that I present on optionhotline.com, it gives you all of these names that I'm looking at every week. So I take the NASDAQ 100, for example, and I try to find the best, 20 names, 15 names inside the NASDAQ 100 and tell you how I'm looking to trade those trends. So go to optionhotline.com/outlier if you are interested, and you can sign up for this product today.
Keith, I can go ahead and put that link in the chat box directly so that everyone listening can go right to the right page without having to root around.
Absolutely. Thank you, Natalie.
No problem.
All right. So Natalie's going to put that in the chat box. I think this is some a product that really does illustrate the value of trading the trend as well as trading the swings. And we're going to get into the swings here in just a moment. So I want to make sure that you understand we've got the trend trading and we got the swing trading, a very different style of trading in the market. But both of them are very, very, valuable and very, very good to do right now, especially with options being as cheap as they are. So let's go straight into the swing trading right now. All right, let's talk about the swing trading setups I'm looking at. The market is setting up for both swing trading opportunities and trend trading opportunities. I talked about the trend trading opportunities. So now I want to focus on the swing trading setups. The thing that I'm looking for right now is a technical setup called a rectangle. Basically, what you're looking for is a stock that can't seem to break through to the upside, but can't seem to break through to the downside. So if I were to put let's see if I can do this right. Here's what I'm looking for right now is this on the left side, the bullish setup. My mouse is, of course, being a little bit of a jerk. There we go. This is what I'm looking for. I want to look for a stock that can't seem to fall, but also can't seem to break out to the upside. Now, if a stock or a sector finally breaks out to the upside, all of a sudden, I don't know where the next seller is. I don't know who's going to sell the stock at what price or the sector at what price. So that's what we're looking for when we find these rectangles, is a stock that's been ranging between, we'll call it $95 and $100, doesn't move, everybody gets bored. And one of the nice things about when everybody gets bored is that options get cheap. So we already talked about options getting cheap being a good benefit for our option trading leverage. Now, when I see something like this happen, there are two elements that I want to make sure I iterate. And that is that risk is always the first element. So even if I think that this stock or this sector could gap up, 30%, risk is more important than reward, because risk is how I define my total capital that I'm putting out at the market here. And I don't want to put too much risk out there when the market might just not go. So when I look at those breakout potentials from that rectangle, if it doesn't happen, I'm going to lose a bunch of money. Okay. So I always set a stop loss for these setups. A breach of the support level of the rectangle is where I may need to cut the position. So when you're looking at this position, if I get that breakout to the upside and then it starts to fall back down and breaks below the lower support line, it tells me that the market wasn't ready to go after all. Or even getting back into that rectangle, getting back into that consolidation zone, it might tell me that I'm not ready to see this happen yet. So I have to have that in mind when I put on one of these positions. For profit, I tend to use standard deviations. Now, standard deviations are an expected daily move or expected annual move. Now, with implied volatility as low as it is, that's where standard deviations actually get really cheap. So what I mean by that is that we're expecting a lot less movement in the stock than we historically have. So the standard deviation then gets that much lower. And instead of expecting, say, maybe a 5% move in the stock, I'm now expecting a 3% move in the stock. That can create some really good explosive leveraged opportunities. So when I start to see this sort of stuff set up, I'm looking for standard deviations to be explosive and to give me a really good profit target earlier than expected. But kind of general idea, 300 to 400% on my initial risk would be a really, really nice return and something that I would look for. So if I start seeing 300, 400% return on my initial investment, I'm definitely looking at the potential exit. The key is that instead of having a normal distribution looks just kind of looks like that the camel hump, where it's a single hump. You have most of the movement up a little bit or down a little bit, and you have some tail risk to the upside or the downside. We now have, if you do the analysis for a technical breakout on the rectangle, we have a bimodal distribution. So what I'm looking for here is that we're either going to go way up or we're going to go a little bit down. So if we go way up, I make a lot of money. If we go a little bit down, I lose a bit of money off of my technical trading setup. If I've got implied volatility cheap, I make a lot of money on that up move. If I've got implied volatility expensive, I'm actually going to have this kind of look the other way, where I'm going to say, oh, a downside move could hurt me more than the upside move. So the key to having cheap implied volatility is that when it happens, along with a situation where we're hitting a sort of a technical point, I can make a lot of money if I'm right. That's that bimodal distribution to the upside. And I can only lose a little bit of money if I'm wrong. And if we go way down, I'm just going to lose the same amount of money. So I'm trying to leverage my portfolio for that upside move here that I think has greater than 50% odds of clicking. And I'm going to lose some money if we don't go up there. That's why I define my risk with options. That's why I leverage my position with options. So I've got my defined risk down here, and I've got my leverage up here. That's the whole point. We've got a situation where instead of having, sort of a coin flip of up or down every day, well, I think we've got a big upside or a big downside move coming. And I think that's the way that the markets are set up right now. We've got either a big upside move or a big downside move coming. Because if we don't have, if we do have sort of this scenario where markets continue to firm, I think that they're going to just kind of get a little bit explosive. And if we don't have that, we could get a little bit of explosiveness to the downside. And that's scary. That's very scary. We don't want to have undefined risk to the downside if the markets get really, really crazy to the downside. So we'll see how things go as we go through earnings. But to me, right now, the market's trying to price us into a position where we can play the upside, but also have defined risk to the downside. Let's look at some of the sectors that I'm looking at right now. And IWM is one of those sectors, and for good reason. If I do a standard drawing, as I did before, there we go. We had a rectangle, right? There's nothing here that is, I mean, it was a range bound market until Monday. On Monday, we switched small caps from a range bound market to a potentially explosive setup. That's perfect for options if they're cheap, which they are, as we talked about with the VIX. Let's look at the next sector I'm looking at here, which is, there we go. Oh, my retail chart didn't show up there, but so when I'm dealing with trending trades, I tend to look for a setup of my triple moving average signal. I want you guys to all look at that. We're gonna send some other information about triple moving averages, but generally speaking, when I'm doing my trend trading signals, I look for 3 to 5 months to expiration, and I look for 60 to 80 delta options. So these are in the money options. You know, when I talked about this back here, where are we? There we go. When I looked at my 60 to 80 delta options here, you know, that's the blue line here. Okay. So it's very similar to a stock position, but because we know that that trend is firm and looks good, it basically is a stock replacement option. And even though it may not be the most leveraged way to play the stock, it does give some really good leverage to the upside, because you can play multiple stocks for the same amount of capital. Okay. Now, when we look at swing trading would look at, there we go, low implied volatility relative to history with a breakout from that rectangle setup. So that's what we were looking at a little bit before with that rectangle. And then I look for 1 month expiration or less, and I look for 30 delta options. So that was that really leveraged high upside potential setup here. And we'll pull that back up. There we go. The green line. So the green line is my swing trading setup. You can see that it can generate returns that are 2, 3, 4x the stock basis. So you've got 2 really good setups right now in the market. We've got a trend overall, and we've got swings setting up with small caps and things for small cap for the swing. So we've got swings setting up in the small caps. That's the green line trade, and you've got trends setting up in the general market for tech and for, you know, the overall market, and that's the blue line trade. So I've got 2 different ways to trade this market. What I do have right now is a really great way to trade the market, whether I'm bullish on swings or bullish on trends. I've got good ways to trade both ways. So again, if I give you the options, my outlier watch list, that's going to give you ideas for what I'm looking at in terms of swing trades or trend trades. So definitely make sure you take a look at that, optionhotline.com/outlier. And if you have any questions, feel free to contact me. Keith at optionhotline.com. 312-600-8004 is my direct number. So call me if you have any questions about how I trade trends, how I trade swings, how I'm looking at the markets. You know, we'll figure it out together. So that's always good. If you have any other questions, feel free to throw those into the chat box or the Q&A, and we will address them as needed.
All right, thank you, Keith, so much. That was a lot of amazing information. I'm going to take screen control just for a minute so I can pop that Outlier watch list page up, just so everyone can see where they can go on Option Hotline to go ahead and read more about it, add it to their cart, and start getting those great updates. Yeah, as Keith said, if you guys have questions, I can see someone click the little hand raise button. We need you to type your question in the chat box or the Q&A box. That way we can read it and then answer it live for you all. So now is your chance. Take advantage of it. We got a question coming in here. Oh, a lot of people are saying thank you, Keith. So thanks again for that presentation. We do have a question coming in from Jeffrey.
Mhm.
He asks, given that a stock has momentum upside during a breakout, the RSI is usually high, like 70 or higher. That make you hesitant to get in.
Absolutely, yeah, no. So when I see an RSI above 70, I'm a little hesitant to get in. That is the correct, I guess.
He nailed it.
So when I see an RSI above 70, I can still see some potential for a swing trade, but it's really, really hard to buy into the trend. So for me, trend trading, I tend to try to buy in when the RSI is like 50 to 60. When it's a swing, I might try to buy in even though the RSI is over 70, but I also know that we may be close to the end of that move. So
okay, gotcha. Thanks. And yeah, that's your personal
that's my
personal opinion and method on that.
Playing those out, yeah.
Right. Yeah, gotcha. Cool. Thank you for that question, Jeffrey. If anyone else has any other ones, I'm getting a bunch of questions about just wanting to reach out to Keith to ask some further questions specifically. Yes, to reiterate what Keith said, just go ahead and either email him, Keith at Option Hotline, or you can use that phone number he put up, or just go to the contact page on Option Hotline and reach out to him that way, whatever works. He's pretty fantastic about wanting to talk to people and educate them and help in any way he can. So please do take advantage of that. With that said, we are kind of pushing right up against our time frame here. I want to remind everyone one last time, go ahead and visit this Outlier Watchlist page, get some more detail about it, take advantage of it. And don't forget to visit the webinars page on optionhotline.com. Sign up for our upcoming webinars. They're always free. They're always good information. And sometimes, most of the time, you might even get a freebie for attending. So you might as well sign up. Keith, it's always a pleasure to have you. Thanks so much for presenting. And thank you everyone who came this afternoon. You were a great audience. And Keith, you're going to actually be back sometime in December for another webinar, if I'm not mistaken. So we'll be able to get that information up on the website shortly, so everyone here can take advantage and sign up again. All right. But in the meantime, I hope everyone has a great rest of their evening. Thanks again to everyone, and we will see you at the next free trading webinar with Option Hotline. Thanks all. Have a good night.
Thanks, Natalie.